The biggest mistakes of beginning investors. Investing money can be a rewarding endeavor, but navigating the financial markets comes with its share of challenges. Understanding and avoiding common mistakes is crucial for building a successful investment portfolio. Let's explore some of the biggest mistakes investors often make. Mistake number 1: lack of diversification. Mistake: putting all your eggs in one basket. Impact: vulnerability to the performance of a single asset or market. Solution: diversify across different asset classes, industries, and geographical regions to spread risk. Without diversification, an investor's portfolio becomes highly concentrated in a specific asset class, industry, or even a single stock. This concentration amplifies the impact of adverse events within that particular sector. A non-diversified portfolio is more susceptible to market volatility. Economic downturns or negative events affecting a specific industry can lead to substantial losses for an undiversified investor. Conversely, the lack of exposure to various growth opportunities in different sectors may result in a missed opportunity for capitalizing on market upswings and high-performing assets. Concentrated portfolios often lead to heightened emotional stress for investors. Sharp declines in a single investment can trigger panic selling, emotional decision-making, and an overall negative impact on mental well-being. How to address lack of diversification. Allocate investments across different asset classes such as stocks, bonds, and real estate to reduce risk exposure to any single type of investment. Spread investments across various geographic regions to minimize the impact of regional economic downturns or geopolitical events. Ensure exposure to a broad range of industries and sectors to avoid concentration risk in a specific market segment. Periodically review and rebalance the portfolio to maintain the desired asset allocation. This involves selling overperforming assets and buying underperforming ones to restore the intended balance. Seek advice from financial professionals or investment advisors who can help design a diversified portfolio tailored to individual risk tolerance and financial goals. Consider utilizing investment vehicles such as mutual funds or exchange-traded funds, ETFs, that inherently provide diversification by investing in a basket of assets. Mistake number 2: emotional decision-making. Mistake: letting emotions drive investment decisions. Impact: buying high, selling low, or reacting impulsively to market fluctuations. Solution: develop a disciplined investment strategy and stick to it, irrespective of short-term market movements. Emotional decision-making refers to the act of making investment choices based on feelings, instincts, or reactions to short-term market fluctuations rather than relying on a rational, long-term strategy. This common mistake can have significant consequences for investors. Emotional decision-makers often buy assets when they are experiencing a surge in value, buying high, due to fear of missing out, FOMO, and sell during market downturns when prices are low, driven by fear and panic. Emotional investors tend to overreact to daily market movements. A single negative news event can trigger impulsive decisions, leading to unnecessary buying or selling. Emotional decision-makers may lose sight of their long-term financial goals and the fundamentals of their investments, succumbing to short-term market noise and sentiment. Frequent buying and selling driven by emotions can result in increased transaction costs, diminishing overall investment returns. Emotional decision-making can lead to increased stress and anxiety, impacting mental well-being and potentially affecting other aspects of an investor's life. How to address emotional decision-making. Develop a well-thought-out investment plan based on realistic financial goals, risk tolerance, and a clear time horizon. This plan should serve as a guide, helping investors stay focused amid market volatility. Implement a disciplined investment strategy and resist the urge to deviate from it based on short-term market fluctuations. Regularly review and adjust the strategy only when necessary, considering long-term objectives. Increase financial literacy to better understand the fundamentals of investing. Knowledge about market cycles, economic indicators, and investment principles can provide a more solid foundation for decision-making. Seek advice from financial advisors or professionals who can provide an objective perspective. Having an unbiased expert can help investors navigate emotional challenges and make more rational decisions. Utilize technology tools to set automatic limits for buying and selling. This can help prevent impulsive decisions driven by emotions. Understand that investing is a long-term endeavor. Patience can be a powerful antidote to emotional decision-making. Allow investments to grow and compound over time without succumbing to short-term market noise. Mistake number 3. Ignoring risk tolerance. Mistake: investing in high-risk assets without considering personal risk tolerance. Impact: sleepless nights, panic selling during market downturns. Solution: assess your risk tolerance before investing and construct a portfolio aligned with your comfort level. Ignoring risk tolerance is a critical mistake that occurs when investors overlook or underestimate their own capacity to endure financial risk. Risk tolerance is a crucial factor in designing an investment strategy, and neglecting it can lead to adverse consequences. Investors who ignore their risk tolerance may end up with portfolios that carry a level of risk they are uncomfortable with. This can result in sleepless nights, anxiety, and emotional distress during periods of market volatility. When confronted with unexpected market downturns, investors who have exceeded their risk tolerance may engage in panic selling, locking in losses and jeopardizing long-term financial objectives. On the flip side, investors with a low risk tolerance who overly prioritize safety may miss out on opportunities for higher returns that align with their long-term financial goals. Ignoring risk tolerance can lead to inconsistency with financial goals. Investors may find themselves pursuing aggressive strategies that do not align with their actual capacity to withstand fluctuations in the market. How to address ignoring risk tolerance. Conduct a thorough risk assessment to understand personal financial goals, time horizon, and the level of risk one can comfortably tolerate. Various risk tolerance questionnaires are available to assist in this process. Seek guidance from financial advisors or professionals who can help objectively assess risk tolerance. They can provide insights into creating a well-balanced portfolio that aligns with individual risk preferences. Employ a diversified investment strategy that matches risk tolerance. Diversification helps spread risk across different asset classes, reducing the impact of poor performance in any single investment. Regularly review and reassess risk tolerance as financial situations, goals, and market conditions change over time. Adjust the investment strategy accordingly to maintain alignment with risk preferences. Recognize that higher returns often come with increased risk. Striking the right balance between risk and return is crucial for achieving financial goals without compromising comfort levels. Increase financial literacy to better understand the different types of risks associated with investments. This knowledge empowers investors to make informed decisions that align with their risk tolerance.